Most people open their investment app once a month. Kai opens his twice before breakfast. This is the morning of the 14th of March. His portfolio is down 19.4%, rounded up to 20% by every financial headline he has read in the last 3 days. He opens the app again. The number is still there. He opens it a third time. The number does not care that he is watching. There is a sell button. This is the first morning he has genuinely considered pressing it. He does not sell, he is not sure why. That is the question this episode is going to answer. Did you know a 20% portfolio drop is not your biggest risk? The risk is what you do next. Most investors have been exactly where Kai is right now. Most of them felt the same thing. Very few of them understood what was actually at risk. Because the drop is not the danger. The drop is a number. What happens in the 30 seconds after you see that number, that is where the real cost lives. I nearly sold. I had my finger on the button. I genuinely thought that was the responsible thing to do. That feeling is not a personality flaw. That feeling has a name. And someone is making money from the fact that you have it. This episode is going to answer 2 questions. What was actually at risk when Kai almost sold? And who designed the system that made him feel that way? We will start with the data, because the data is the most important thing Kai did not have on the morning of the 14th. In 2024, the average equity investor earned 16.54%. The S&P 500 returned 25.02% that same year. The gap, 884 basis points, was the second largest investor performance gap of the past decade. 888 basis points. On a 50,000-pound portfolio, that is 4,240 left, unrealized, not because the fund underperformed, because the investor did. To put that differently, the S&P 500 grew 25%. The average investor captured 66 cents of every dollar that growth produced. The rest was left. Equity fund withdrawals occurred in every single quarter of 2024, not just during corrections, in every quarter. The largest outflows, the biggest selling, happened just before a major return surge. Investors sold at maximum pain. The recovery came immediately after. DALBAR has been tracking this pattern since 1985, 40 years. In every decade, the gap between what the market returns and what the investor captures has persisted. That gap is not caused by fees. Fees are included separately. The gap is caused by the decisions investors make while holding the fund. So the market goes up, and the investor still ends up with less, not because the market failed, because the investor kept reacting. And the most common reaction, the one that drives the gap, is selling during a correction, not when the market is falling. Selling because of how the fall feels. The feeling Kai had on the morning of the 14th, that feeling is documented, measured, consistent across 40 years of investor data. It has a cost. March 2020, the S&P 500 fell 34% in 33 days, the fastest bear market in recorded history. At the bottom, the single worst day, the phones at every major brokerage were ringing. Investors were selling. The recovery had already begun. Investors who sold at the March 2020 low locked in a 34% loss permanently. It became real the moment they executed the trade. Investors who held recovered fully by August 2020, 5 months from the March 23 low. Same portfolio, same market, same fund. 2 different outcomes. The single variable between those 2 outcomes was one decision, made in one moment, by someone who was feeling exactly what Kai felt on the morning of the 14th. So if I had sold, even though the fund recovered, I would have locked that 20% drop in permanently. I would have made an unrealized loss real. Correct. An unrealized loss is not a loss. It is a number on a screen. It only becomes a loss at the exact moment you choose to sell. The investors who held in March 2020 did not have better forecasts. They did not know the recovery was coming. They simply did not act on the feeling. So here's the answer to the question this episode started with. Did you know a 20% portfolio drop is not your biggest risk? No. Your biggest risk is the decision you make in the 30 seconds after you see the 20% on your screen. If your portfolio fell 20% and you held, you realized nothing. Not 1 penny of that drop was crystallized. The market fell. Your number changed on a screen. Your wealth did not change. An unrealized loss has no financial consequence. It only becomes financially real at the moment you sell. Before that moment, it is entirely recoverable. The market has recovered from every recorded crash in history. Not overnight, not without discomfort. The pattern has held across all of recorded history. An unrealized portfolio drop is not a loss. It becomes a loss only if you sell. 40 years of data shows investors who sell in downturns lock in losses a patient investor never experiences. The investors who built wealth through market crashes did not have more courage. They had a clearer understanding of what an unrealized loss actually is. So on the morning of the 14th, the portfolio was fine. I was the single variable. The system was designed to make me that variable. Correct. The portfolio was doing exactly what portfolios do. The question was what you were going to do while it did that. And the answer, the one that 40 years of data confirms, is nothing. Do nothing. That is the entire strategy. That is the thing that is hardest to execute. The wrong belief is, a 20% portfolio drop means you have lost 20% of your money and you must act. This belief is wrong. It is also not your fault. In 1979, Kahneman and Tversky published Prospect Theory. The core finding, losses feel approximately 2 times more intensely than equivalent gains. A 1,000-pound loss feels more than twice as painful as a 1,000-pound gain feels good. Wikipedia confirms this ratio. The research won the Nobel Prize in 2002. This is called loss aversion. It is a feature of human cognition. It affects every investor on the planet, including the ones who held in March 2020. Kahneman was awarded the Nobel Prize in Economics in 2002. Prospect Theory is the second most cited paper in economics, 1975 to 2000. Econometrica, 1979. Loss aversion is not telling you to sell. It is telling you that losing feels worse than winning feels good. That is biology, not financial analysis. The feeling Kai had, finger over the sell button, was prospect theory activating. It was accurate about the pain. It was wrong about the action required. Financial news applications are designed to send push notifications at the precise moment of maximum portfolio pain, not to inform you, to engage you. Engagement spikes during market downturns. That spike is what they sell to advertisers. Your fear, at the worst possible moment, is their highest value inventory. The red color on your portfolio screen was a design choice. The notification timing was a design choice, both chosen to activate the feeling, not to help you manage it. The moment you open the app after a drop, the moment Kai opened it a third time on the morning of the 14th, that is a monetizable event. The system profits when you sell, not when you hold. Every trade you execute in fear is a revenue event for someone else. The platform earns whether you are right or wrong. Kai's portfolio dropping was not a problem for the financial media. Kai almost selling was the outcome their product was designed to produce. Every financial news outlet, every brokerage app, every push notification is optimized for one metric: time on platform. Downturns are their highest traffic moments. DALBAR QAIB 2025. The average equity investor underperformed the S&P 500 by 888 basis points in 2024. Not fees, not the fund, decisions. Kahneman and Tversky, 1979. Prospect Theory, Econometrica. Losses felt approximately 2 times more intensely than equivalent gains. Nobel Prize in Economics, 2002. DALBAR QAIB 2025. Guess right ratio, 25% investors correctly timed their buy and sell decisions 1 in 4 times in 2024. So the portfolio dropping wasn't the problem. Me almost selling was the problem. I had a real loss in my hand. I almost made it real. The number on the screen was not real until I touched it. The fear was real. The loss was not. I almost confused the two. Close the app. Set 1 calendar reminder. 12 months from today. That is the entire system. Nothing else is required. You do not need a strategy. You do not need a financial advisor to implement this. You need the ability to do nothing until that reminder arrives. The investors who held in March 2020 did not have better information than the ones who sold. They had a plan that did not require them to feel confident in a crash. A patient investor who holds through every correction since 1985 captures the full market return. The reactive investor who responds to each correction does not. Kai almost sold. He didn't. That single decision, the decision to do nothing, will compound in his favor for as long as he holds the position. Here is the 1% detail. DALBAR tracks something called the guess right ratio, the percentage of times investors correctly time their buy and sell decisions. In 2024, the guess right ratio was 25%. Investors made the correct timing decision 1 in 4 times. 3 in every 4 timing decisions were wrong. And each wrong decision was a transaction. Each transaction generated a fee for the platform. The system did not need investors to be right. It needed them to keep trying. Each time I opened the app, even if I had been right, I still had a 75% chance of making the wrong call. And someone earned from the attempt regardless. The data does not say do not invest. The data says do not react. The market rewards patience more reliably than it has ever rewarded timing. So it is called an unrealized loss, which means it is not actually a loss, not until you sell, at which point it becomes real. His flatmate considers this for a long moment, then very carefully. So the number is wrong, but also correct, until it isn't, and that's the bit you have to not react to. Kai looks at him. Yes, exactly. That's it. His flatmate nods, thinks for one more moment. Then, so why do you look like that? Her bonus disappeared. Her salary built wealth. Same amount, same person, same bank account. Here's the brain science behind why. Episode 13. Next week. If this changed how you think about your next market drop, share it with someone who needs to hear it before they sell. The button is right there. Next week, episode 13. Your bonus, your salary. Your brain has a different account for each one, and someone built their retail calendar around that. Subscribe, new episodes every week.